For real estate overall, I think that actually for us the key trend links back to artificial intelligence, data center build out, and the infrastructure that's needed. I mean, AI and technology automation is a huge theme for us. It has been for a while, but it still continues next year.
They only buy the site for it. They don't build the data center. They may put up the frame or something, but the actual technology is nothing to do with the real estate players, is it?
No, but you need to have the land, as you mentioned before, you need to have the permitting capabilities. So the AI value chain is what we're interested in.
Yeah.
The most sort of relevant part of that to us now is actually the power part, the power piece when it comes to AI. Magnificent Seven, a lot of that story we think is quite well captured in valuations, but the bit that is to come that still links very much to AI adoption, which will be the key stat I'll be watching, is power needs.
That's fascinating because, okay, stateside it's a different picture, but when you're looking at the power providers for data centers in Europe, they are facing a wealth of problems from NIMBYism, from regulators, from permitting as well. It's a tortuous task. Quite frankly, a lot of them are choosing to invest in the States because Europe's too tough to deal with.
Yes. And so it brings us back to US exceptionalism. And is that the right thing, and what's discounted in markets? And our view is that US is going to continue to demonstrate exceptional GDP growth, exceptional growth opportunities for corporates to generate earnings and share buybacks. So you've got that incremental buyer, and therefore we are overweight the US. But we invest globally. And I think that's a really critical point that links back to earlier conversations by sector, including European luxury, that there are many risks in the world, and there's also a lot of complacency. So portfolio resilience, which includes a big lean into diversification, is absolutely critical for this year. Even if we get a third year of strong risk asset gains, we think you want to be diversified because I think more volatility is coming.
Grace, what do you make of the lightening up that we've had stateside over the last number of sessions? Is that a reason to regroup and think about positioning, and if you were not overweight enough in the US markets, this is your entry point?
Yes, I mean, pullbacks are to be expected. We've had a 4 or 5% pullback, and I think that you'll see some coming in to buy that dip. Generally, I think it is highly consensus to be overweight the US already. When we think about how our clients are thinking of allocating, it's still very much in the US, and that's around the global private bank. And as I say, we're overweight there too. So I do think that dips will be bought, but that we should expect deeper dips than the one we've just experienced so far this year. If you look back over the last 40 years, the average pullback in markets is 14% in any one year, but markets end up 78% of the time. So that is where the portfolio resilience theme comes in as well, that you've got to anticipate volatility. And Steve, I agree with your earlier comment before this section that inflation is going to be a source of volatility, bond market volatility, whether it be driven by inflation expectations or term premia. I think that's going to be another big theme around deficits
but it's already
this year.
happening, and that's amazing.